We'll continue the discussion of consolidation as part of the lecture series on business combination or consolidation according to IFRS 3 and IFRS 10. In my previous video, we discussed about purchase consideration, how to arrive the fair value of purchase consideration. We discussed four methods: upfront cash payment, share exchange, deferred consideration, and contingent consideration. In line with this discussion, today I'm planning to take a topic called intra-group trading. So we will discuss today how to deal with when we happen to have this situation. Now, what really we try to mean, we may have, let's say we have a parent company and we also have a subsidiary company. We do have parent company and subsidiary company. There is obvious possibility that there can be transactions can take place between the company. Sometimes the parent could sell goods and or services to subsidiary. This, when parent is selling goods or services to subsidiary, we name it a downstream transaction. They could sell their goods, inventories, or sometimes they could also sell their properties. They could even sell their services. On the other hand, at times the subsidiary can sell their goods and or services to parent company. That's a second possibility. So this one, the first one, we name it downstream. The second one, we name it upstream. So first of all, you all need to have that understanding. Whom he is selling to whom? Who is selling to whom? So when sometimes parent company can sell goods to subsidiary, or sometimes subsidiary can sell goods to parent company. Now, to analyze further, a situation when parent company is selling goods to subsidiary, regardless of the percentage of ownership. Let's assume the ownership percentage is 80%. The parent company holding 80% stake or the shares of subsidiary. That means there are 20% owned by non-controlling interest shareholders. In this situation, if we make an assumption that parent company sold goods to subsidiary, selling price, let's say $200,000. Parent company sold goods to subsidiary and the selling price, the sales value is 200,000, and they make a margin of 40%. They make a margin of 40%. Now, what we need to understand that the price, the selling price, sales value that the parent company would be booking at, the parent company will be booking this in their P&L as the sales 200,000. Now the question is, how much is the cost? Now when parent company is selling these goods to subsidiary with a margin of 40% and the sales value is 200,000, so how much is the cost? To work out that, what we need to do, 200,000, and then we need to arrive the cost percentage. When margin is used, the sales value is at 100%. So the cost will be 100 minus 40, which is 60. So 60% of 200,000. 60% of 200,000 will be 120. Accordingly, the cost of sales or the cost of this particular sales is 120. Therefore, the company makes a profit of 80,000. Now, as we understand that, the parent company is selling goods to subsidiary and then they have made a sales of 200,000. Remember, these sales taken place within the group. Now, we will talk about slightly more how to deal with that when the goods are not sold by them. So what I just wanted to establish, what is the profit? So parent company had generated a profit of 80. Now on this 80, I'm coming back to the ownership percentage. 80% parent, 20% subsidiary. Is there any impact or any relationship with regard to the percentage of ownership to the extent of the profits made when it is downstream? Remember, in downstream, there is no stake for non-controlling interest shareholders. It is only to the parent. Now, or conversely, the same example, when the subsidiary is selling goods to parent, it is 200,000, the sales value, margin is 40%, so therefore profit will be 80. Now, scenario different, it is upstream. When it is upstream, what happens is that now the ownership comes into play. The ownership percentage here, 80% to parent and 20% to non-controlling interest shareholders. Therefore, on the profit they made, 80% will be attributed to the parent company and 20% will be attributed to NCI. Accordingly, 64,000 should be taken to parent company and 16,000 should be to subsidiary. So this is a simple scenario where you have this intercompany trading. So the parent company is selling goods to subsidiary. Later, when we discuss consolidated profit and loss account, such type of intercompany trading, we should eliminate each other in arriving the consolidated results. When time provided, we will discuss that. Now, what happens is that in this situation, if you make an assumption, when the subsidiary sold goods to parent, the above same example, and the parent did not sold, or I would rephrase it, parent sold 50% of this inventory, 50% of inventory was sold. So now what is the situation? Now we know that we have made a sales of 200,000. So in the parent's books, he will be keeping the inventory value at 200,000. Now the parent company, when they reach into the year end, they have sold 50%. So how much inventory there must be within the inventory of warehouse of the parent? So 200,000 times 50%, which is 100,000. This is only the inventory value. One more thing you need to establish, according to IAS 2, inventory should be valued at cost or NRV, whichever is lower. So this 100,000 is at the selling price to the group. It is not at the cost. So we need to bring it down to reach the cost. So what we should do, 100,000 times 60%, which is 60,000 is the cost price. So the remaining 40,000, which is built into this 100, is known as something called unrealized profit. Remember that what you mean by unrealized profit, those profits are booked within the group and it is still not materialized outside the group. Now I have the parent company P, subsidiary company S, and I have done a transaction. Subsidiary has sold items to parent and parent is still keeping the item within the books of the parent or within the warehouse of the parent. The custody is with the parent. Therefore, such inventory we should value at cost. Then whatever the profits that is booked by the subsidiary, it is still not materialized, we need to remove. This we name it unrealized profit. So what we should do for this, we will have to bring one additional memorandum entry that we call it, we need to offset the unrealized profit. Now, in the books of the subsidiary, in their retained earnings, we have to remove this 40,000. So I will debit 40 here and transfer to a temporary account called unrealized profit account. So in the unrealized profit, I will have this 40,000 coming from retained earning. On the other hand, the parent company will have inventory. Inventory is booked or shown at 100,000 after selling the previous 100,000. Therefore, this 40,000 is what got built into this, inside this 100 we need to remove. So what we do, 40, we call it offset, and that 40 we need to offset here as well. So when you do that, this will become 0, and here remaining will become 60. So this is what you need to do when you approaching an exam question. You have to pay a very important attention to these particular adjustments. Continue to tune into my channels in order to get benefit of this particular technical discussion. Thank you so much.